2016, The Importance of the Business Cycle, or Why I Learned to Reject Theoretical Economics. This was something that I really had in my mind when I started Real Vision. I wanted to get across. And I walked RV members through my framework of building a business cycle framework for investing. And it really did change many people's lives. Most people weren't using the business cycle then. Now, obviously, a lot of it's going to be out of date now, but you can understand how I worked. Now, even I've evolved somewhat, but I think you'll find that there's something in this for you and you can learn. Whether you're a Plus member, a Pro member, or an RVIP, you've got access to these macro tools that have now become the macro investing tool. That's all based on this framework. So I think you'll really, really enjoy it. I've been in the global macro business for 26 years now. And over my time of analysing markets and trading markets, I've realised that the study of economics really lets people down. And we use global macro, meaning global macroeconomics, and we're supposed to be basing our strategies around that. But once you start looking at economics, you realise there's a big flaw in how economics are presented to us, what's taught at universities, and how we understand global economies. In my world of trading markets and looking for opportunities and risks, I'm not interested so much in theoretical economics because theoretical economics don't work. You tend to see words like ceteris paribus, which means all things remaining equal. And that tends to give away something, meaning that this doesn't work in the real world. And that's the problem we've got to in this world, where we've had extreme uses of Keynesianism, economic policy, and monetarism. And the two lots have been blended now, where we're trying anything in which to get ourselves out of a bigger picture issue. I spent a lot of time, I guess since really the late 90s, trying to understand other ways of looking at economics that may be more applicable and maybe more real life. And I think real life economics is what's important. I think the studies of behavioral economics are very crucial in this. And so for me, the thing that I stumbled across, that I seem to be one of the few real proponents of these days, and it's weird, is the business cycle or cycles in general. Global economies ebb and flow over time. And you can see that when you look at any chart of GDP growth anywhere in the world, it goes up and down. It's that up and down that I'm interested in, because what happens is economies trend. And if they trend, it makes them forecastable. And if they're forecastable, we know that they also can affect asset prices, and therefore asset prices become forecastable. So it's this age-old trend. I mean, it goes back to the crop cycles in Egyptian times. There's always been a business cycle. There's always been big secular cycles driven by a number of factors. So what I wanted to do is go through the various types of cycles. The secular cycle, which is sometimes called Kondratiev waves. Then there's the business cycle and the shorter term business cycle. And many of these break down to other cycles too. It's going to sound very complicated at first. And in the end, I'm going to show you how to put the whole lot together and make forecasting economies and asset prices much easier than you ever imagined. It's not some sort of voodoo process. It's all really about probability analysis and understanding trend and cycles. So the first cycle I think we should look at is the secular cycle, or the Kondratiev wave, as some of the Austrian economists used in the past. Now again, let's just not confuse Austrian economics with what I do in the business cycle. Mine's much more practical related. Again, theirs is a bit more theoretical, but it's based in that element of understanding there is a boom-bust cycle and you can't avoid it. If you avoid it for certain periods of time, you end up with a bigger boom or a bigger bust. So anyway, so the longer term cycle, how do we look at that? How do we understand really what the long-term picture is? This is where I start with everything. This is where I form my global macro framework. And the one I look at first is demographics. What's happening to the demographics of that country or that region? So for example, we know in many of the Western countries, the demographics have aging populations. Aging populations tend to mean that consumer spending over time declines. At first, an aging population means people invest in stock markets for their retirement, but in the end, they divest money from their savings to spend into retirement. So that drives a lot of economic behavior. and it's very important to understand demographics. We have demographics, as I mentioned, in the West, where things are looking increasingly less robust. Therefore, we're seeing slower economic growth over time. It's more deflationary. For example, my father retired several years ago, he's 78 now, but when he retired, his spending patterns collapsed. He didn't buy a car every 2 years, he bought one every 5 or 6 years. And that's a very deflationary situation. And that's one of the reasons why we've got a secular decline in inflation rates and edging into deflation. Also, there tends to be excess savings in that cycle because these people need money to retire. That also drives down interest rates over time. And also stock markets, as I said, were driven up by these, tend to get driven down over time by this process. I'm also very interested in places where the demographics aren't the same as the West, because you like to have a world where you've got longs and shorts. I may be somewhat more bearish on the Western world in terms of asset price performance, but I'm very bullish on other places, and I've talked a lot on Real Vision Television before about monsoon. And monsoon is a region which is basically around the Indian Ocean, and it's the countries with the best demographics in the world, and the highest saving rates in the world, and the lowest debt per capita in the world, and the lowest government debt in the world. Those are kind of like the US economy was in the 50s and 60s, when the US had the baby boomers just starting, and people went out into the workforce and bought their first car, their first house, their first suit. That huge incremental spend is A, inflationary, but B, tends to drive massive economic growth. I'm going to appear a lot less on camera in this particular presentation because there's some charts I need you to look at and spend some time dwelling, so I'll kind of talk behind the charts if that's all right. The first chart I want to look at is the chart of the long-term equity market cycle. That's another chart we add on to the demographic cycle to get an understanding of where the global economy is going or the particular market we're assessing. How I look at this is use the 10-year moving average of the year-on-year rate of change of equities. I know that sounds a bit complicated, but basically it gives you the equity cycle. You can see from the chart, equities are very cyclical when we look at it in those terms. We know that once they've peaked, we're going to get declining returns of equities going forwards for the best part of a decade or longer. We saw the very sharp fall that we had from the 2000 high going down into the low back in 2009. However, it's bounced back up again, and I'm not entirely convinced that this market cycle is over because the time is very short versus previous cycles. So that tells me that this is probably a shadow bounce in terms of returns, and likely going forward is a process of more low returns coming out of stock markets, and I think that will mean negative returns to come. And I think the final bottom of the cycle will play out maybe in the next 5 years, which will be basically in line with the other cycles. And that's some of the important things to know. What we're looking again is probability. The probability is that we think it will hook back down again, much like it did in the mid-30s, you can see on the chart. So if that's the case, then it's going to come back down to the low levels that we saw before. Any cross below about 5% on this chart means we get some really nasty surprises in a terrible economy. Knowing the global imbalances that we've got, the chances are still high that that's the case because those imbalances haven't been cleared. All of the other market troughs, we saw very low market valuations and low debt levels. We haven't got to that clearing point yet. So I think that's to come. And again, this probability allows us to understand when this is likely to happen because we understand that there's a certain length to the cycle. So if we think the cycle now is rather short, we know that there is a period of time for which we should be expecting the bottom. It gives us a probability that the bottom is still yet to come, and that's how we need to think about things. So now we can understand demographics and how they drive things. We can also understand the equity market cycle. So the next thing we need to, and that's probably driven by demographics partly, to be fair. The next part we need to look at is the commodity cycle. Commodity cycle is one of the oldest cycles of all. So the chart you're looking at now is the overall commodities GMI composite supercycle. It's a long name, but basically it's a mix of a whole load of commodities. And then we look at the 10-year on 10-year moving average. And again, you can see it's very cyclical. Now, what it tells us is the cycle has not bottomed yet, that this is the global commodity supercycle bust that I've talked about on Real Vision and many of the other guests have. We know that that bust takes a certain period of time to get to, and we know that commodity returns stay around zero on a 10-year on 10-year basis for an extended period of time. Those bottoms last maybe a decade. So we've got a long period ahead of both falling returns from commodities and then a whole period of stagnant or low returns from commodities. Many of you remember the final part of that in the late 90s, before gold and oil and all those other commodities took off. That was the final part of the commodity supercycle bust. That all lies ahead. So I really can't be bullish about commodities in a meaningful long-term way for a long period of time. That doesn't mean that precious metals or cannot outperform, because I know many of you are interested in precious metals. It does mean, however, that generally the commodity complex, and I'm meaning mainly the industrials and potentially also the agriculturals, don't tend to do well. The next part of the long-term cycle framework that I use is the debt supercycle. I think many of you are familiar with that. It's the big boom and bust and build up in debts that happens over generations. And it's that big unwind, the secular unwind, the debt deflation, that is an interesting part to us, or the big boom. So again, we can talk about countries like India, or countries in the Middle East, or countries around the Indian Ocean that have very low debts and a good demographic. We would therefore imagine that over time, that young population will borrow money with which to buy houses and cars, and the debt supercycle begins. And that will run for several decades until a point where the debt becomes unsustainable. Countries will ebb and flow within that, and some will have a debt supercycle that runs too quickly. Egypt, for example, had it recently. They had too much housing build. We've seen that in the Middle East somewhat in various places. But other countries don't have too much debt issues, but over time they will. But again, when we flip back to the West, we can see, or we understand, that there's huge debt problems. The US alone, if we look at total debt to GDP, to world GDP, is the most indebted country as a percentage of world GDP of any country in history. Also, the world is currently about 350% debt to GDP, which is the highest ever recorded in the world. So we have a massive debt supercycle underway. We know the rate of change of debt buildup is now falling. That rate of change is the peaking out of the cycle, and then we've got the overall bust to come. The overall bust has to be when debts get written off, inflated against, or devalued against, but that debt has to go, and it can take a long period of time. The chart I've decided to use to illustrate this point is the US total debt as a percent of GDP, which I referred to earlier, but the 10-year on 10-year percentage movement. Now, what you can see again is it's cyclical. We had a huge build-up in debt in the early 80s, and that debt has over time been slowing, and we can see the big rate of change, which I was talking about, the importance of the rate of change happening now. We've got an enormous falling off in the rate of change of debt buildup, and that generally indicates to you that the debt supercycle bust is underway, and that process will take decades, if not longer, to sort themselves out. We don't know how it's going to finish, whether it happens in a big shock, and I've talked about the reset before. I've also talked about a debt jubilee, which is debt forgiveness. These are maybe the ways we do it. We don't know. Maybe there's a hyperinflation or inflation out of debt. But over time, debt burdens are unsustainable. And I know many people, particularly in the Keynesian camp, will say, you know what, we can run debt burdens forever. We'll just finance them by printing of money. Well, in the end, that doesn't work, because something lets that debt unwind, because what happens is the massive amounts of debt causes a fall in the velocity of money. And therefore, any increase in debt or quantitative easing or any form like that has limited impacts. So eventually the debt burden just becomes too big, or deflation comes, and your debt burden in real terms keeps going up. And that's why everyone fears deflation, is the rising debt burden when you've got such enormous debt burdens already. So when we put all of these together, we can see that the equity cycle, the commodity cycle, the demographic cycle, the debt cycle are all going lower. So if that's the case, then we can't imagine a world where there should be protracted growth. It should be low growth with a bias towards periodic busts. And this is why I have a bearish bias right now. People think, I'm the great bear. I'm not. I'm bullish on other places that don't have this setup. This setup just generally tends to create problems. And it means that the risk reward gets skewed towards more risk and less reward. And I know that looks a bit funny after we look at the equity markets over the last 5 years or so. But when you look back, equity markets have produced virtually no returns over the past decade, if not longer now. And I think that's the thing. I'm looking at longer term cycles here. I'm not talking about the shorter term cycle. The shorter term cycle is really the crux of what we need to use for investments. One is the framework, our secular framework. Next is how we implement that framework and where we are within it. And that's why I use the business cycle. So the chart you can next see is an idealized business cycle. It kind of goes up and down. That's the boom bust cycle. we're so familiar with. And it would be perfectly measurable if it was like this, because then we know exactly when the trough comes, exactly when the boom arrives. However, it's not like that. It's variable, but it is still predictable because there's a range of outcomes that we know. We know there's a certain length to each business cycle. On average, we know what the longest one is, the shortest one is. So once we know that, we also know that, as I mentioned before, business cycles can trend, and you can see that once it's peaked out, it goes to a trough. That's boom to bust, recession. We know there's a certain period of time, we know there's a certain depth to that cycle. So that helps us forecast things. But let's have a look at the real world a bit. This chart is the business cycle versus recession indicators. The recession is grayed out on the chart. Now, as you can see, it doesn't quite look like that idealized cycle, but you can see it is a boom-bust cycle. It is cyclical. It goes up and down there is no disputing that. This is the simple failure of most economists to understand. This is why almost all economists never forecast recessions, because they look at linear models. They take a snapshot of the world today and assume that's where it's going to be tomorrow. It's utterly clear that once you've had a peak in the business cycle, you know that the next major thing in the business cycle is going to be a trough, which will be a recession. Therefore, you can forecast a recession and when it's about to come and how long it will take and what it's going to look like. So what is this voodoo magic? Where does this cycle come from I've just produced? Well, it's really simple. And you've heard me refer this many, many times before, both in my written research and also in Real Vision. It's the ISM. The ISM is our best guide to the global business cycle. It's a bit weird because it's the global cycle and it's the ISM, but I'll come on to all of that later. The ISM is the Institute of Supply Managers survey in America, and they survey purchasing managers and ask them about business conditions, inventories, sales, and that kind of thing. And they create a composite index. And that composite index has been going since 1948. And prior to that, there was something called the Treasury Survey that started, I think, in about 1896. I have all of that data and use it all the time. This is where I think my competitive edge, if I have one at all, is in understanding this. I'm a bit of a nerd when it comes to the business cycle. And what I love is very few other people understand it. Yet it's so intuitively understandable once I explain it to you that within 10 minutes, you'll be able to make your own forecasts about economies and about asset prices as well. I've been around various universities talking about why what they teach you at university in economics is rubbish. And I base it on this to say, I can get you as a student to forecast the economy better than most Wall Street economists over the next 3 to 5 years. And I think that's the genius of what the business cycle does for us. So this chart is the chart of the ISM, as I mentioned before. Basically, what you need to know is when it crosses 46, there's a 100% chance of recession. When it crosses 50, there's about a 65% chance of recession. When it crosses about 47, the odds rise over 80%. How do we get those odds? Well, we basically look back of all other past examples and calculate the odds. How many times did it do this at this certain time or this certain level? So that's how we get odds from this. So I know recently that the ISM has been bouncing. I think it's likely to be a short-term bounce because of the secular cycle that we know and that we have not had a recession yet. We may be starting one that I've been calling for some time now, suggesting that 2016 is a recession year. It's a bit early to tell, but I still think it will play out that way. But the point being is the likelihood is that the ISM still has further to go to the downside. There are times when it didn't, and we can see the failures in the mid-90s where it chopped up and down, but we didn't get a recession. That was the Greenspan years with excessive use of monetary policy that got us to a lot of the problems we are today. It's a concept that I've talked about before, which is suppressed volatility leads to hypervolatility. Greenspan thought he could manage the business cycle and eradicate it entirely. And again, economists and media grouped together and said the business cycle is now dead. That was just rubbish. They suppressed it. And what happened after that was 2 recessions. We had a bust of the tech bust, then we had another boom, and then an even bigger bust. And I think that process still has not played out because the debt bubble has not played out. So that the hangover from both the Reagan years and then into the Greenspan years with the big debt buildups, those haven't gone yet, and they're still yet to be worked out. So anyway, my bias is for the ISM to continue to fall over time. Again, I can be wrong. It's based on probabilities, but I still think the probability lies in my favor.
You want to unfuck your shit? This is live.
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there, and let's help you unfuck your future. So why do we care so much about the ISM? Well, this chart shows you why you need to care. It's the ISM versus US GDP. They're basically the same thing. So the business cycle is the economy, which is the point that so few people understand, but make it very simple. So therefore, we know where the economy's going if we know where the ISM's going. So when the ISM hits something like 46, we know the US economy is going to be in recession. So it's going to be at 0 or below. So that allows us to forecast going forward what we think is going to happen, because both the economy trends and the ISM trends, because they're the same thing. You might say, well, this is just the US and the US isn't the world. Well, the point I'm going to make is it is the world. This chart that I'm showing now is the ISM versus world GDP. They're highly correlated. There's a number of reasons for this. Firstly, the US is the largest consumer of goods in the world. So they drive everybody's manufacturing cycles, which is a key component to the business cycle. They also drive the debt super cycle. So with that debt, they bought more and more goods. So the US is the key consumer in the equation of the world and drives the world's business cycle. And I think that's very important. Also, US manufacturers are prevalent all across the world. There's big manufacturing plants in China or Turkey or wherever else in the world. So their activity drives the business cycle in those countries too. But you might say to me, you know what, Raoul, yeah, that's a bit funky chart. You love putting these correlations up, but they don't really mean anything because, the US is a big part of global GDP. Yes, it is a big part of global GDP, but the point is this relationship is prevalent across many, many countries. So here's the chart of the ISM against South Korean GDP. And again, they're highly correlated. Why is that? It's because one is the consumer and one is the exporter. And that's how the globalized economy works right now. So anything that happens in the US economy drives the South Korean economy. This is one of the reasons I'm bearish on South Korea right now. It has a lot of debt itself, but it's behest of the US cycle and also the Chinese cycle. And the Chinese cycle is largely negative now for the same reasons: debt, demographics, deflation. I know that these kind of charts don't fit into the world of theoretical economics because you can't model them as easily. I think you could model them if you understood, or if I was smart enough to model them. But basically, it's the nuances within this that's important. It's not you just read the level of the chart and that's where GDP is. We can do that, but that's taking a snapshot of now, here and now. That's not what I'm interested in. I like to look into the future. That's what we do in global macro, and that's what the investment world does. You have to live in the future and understand what the path is to get there. So as I've shown, we now know the global top-down framework. We know that the global economy is generally, particularly in the developed world, weakening over time. We know that gives a propensity towards recessions and slow economic growth. We've then looked at the business cycle, and we've seen how it correlates to the US GDP, global GDP, and countries around the world. We know that the business cycle is rolling over. It peaked some time ago, back in 2011, in fact, and therefore the probability should be of a weak business cycle going forward. We could get an outcome like the mid-90s, where the economy just kind of muddles through for a while and asset prices continue to do well. I think that's less likely. There is a probability of that. So I think once we combine all of this, our propensity has to be to assume that things go lower, rates of return go lower, and economies go lower. So the next thing we need to look at is, what use can we make of this? Why does it really matter to us? Why does Raoul endlessly bleat on about the business cycle? And I think this is where the important thing is. Let me flip up the first chart, and this is the chart of the S&P year on year versus the ISM. So here you go. You can see the chart that I have put on Twitter quite a few times. I've also write about endlessly in GMI. It's one of the core components of what I write about in GMI. And it's also something I've referred to on Real Vision. I promised you this video for this purpose, so you can better understand the business cycle too. The relationship between the ISM and the S&P year on year is incredibly close. Again, we're not looking for the correlation of every data tick. Some people come back to me on Twitter and say, it's only got this correlation when you look at the data ticks. I don't care about the data ticks. It's the trend we care about. Once we understand the trends, we can understand that if the ISM is falling, then the rate of return in the S&P is falling. When the ISM crosses something like 50, the rate of return in the S&P versus a year ago is negative, or 0 to negative. And I think this is the important thing to know. So this is why when you have recession, equities tend to be in a bear market, because of the relationship to the business cycle. Why is that? Well, obviously, corporate earnings are all related to the business cycle. In a strong business cycle, you make more profits. In a weak one, you make losses. And that's just how the world works. So equities have to be the business cycle. Now, what's interesting in this chart is you don't see what everybody says is the QE buildup or the bubble that's created by quantitative easing. There's no disconnect in this chart. It tells you that over time, that valuation increase, that's a trend that doesn't get picked up, particularly in this ISM. We're not really looking at the long-term valuation trends here. What we're looking at is the disconnect from the economic cycle or the future trends. I'm a big student of history, and I don't like people who use charts over the last 3 years and go, there you go. There are 3-year correlations that work, and sometimes they fall apart. Again, it's looking at probability of it falling apart or not. But I think this next chart, I think that might blow your mind. This is the ISM and the Treasury survey going back to 1896 and their relationship with the year-on-year S&P. It is extremely good, and it always has been. So once we have something of that quality, that history, we know we can give it massive credence. So if anybody says it's a spurious correlation, they clearly don't understand what they're talking about. And again, why simple economists cannot understand these relationships or strategists and forecasters is beyond me. It doesn't mean I'm always right. Clearly, I've got it wrong several times. But what it means is over time, I will have a probability chance of getting it right more often than somebody who use linear extrapolations based on models. Again, just to get the point home about corporate earnings, just so you really understand the relationship, this is the chart of the S&P 500 versus earnings per share adjusted year on year. Again, you can see, as expected, hugely correlated. So any strategist who tries to forecast anything to do with equity prices without understanding this is a charlatan. But you know what's great? Is it's not just equities I can predict with the business cycle, because obviously commodities move too. So let's look at this next chart. It's the chart of lumber year on year versus the ISM. Again, the correlation is incredibly good. So now you can become a lumber expert in seconds. You knew nothing about lumber. Now you know what the year on year change of lumber is going to be. You can extrapolate a price versus where it was last year and understand what your forecast would be for lumber prices going forward. It's pretty easy, really. But you know what? This magic cycle is not just lumber, it's also copper. Copper, Dr. Copper as people call it, it's an economic indicator. Why? Well, look, it perfectly matches the ISM. There are a couple of times when it doesn't, and commodities can get into this phase of massive excess speculation or a huge increase in demand. The main couple of times that we've seen something change in copper were the two massive spikes in the early 2000s. And that was based on China and their huge infrastructure spending. First one was going into the recession. Just before the recession, the Chinese were running a hugely hot economy, creating massive demand for copper. Then it was this massive stimulus after the recession that caused another buildup of bridges and roads and stuff in China, excess capacity, that caused a spike in the price of copper year on year. But overall, again, we can predict what's going to happen to copper prices going forward. And we also know that the secular cycle in copper is going down. So now we have a view. The secular price of equities is going down. The secular price of commodities are going down. And we've also got the business cycle in copper is pointing lower. The business cycle in equities is pointing lower. Now you're building an investment framework very quickly, and you're starting to understand how to forecast this stuff. And again, there's more magic to come. It's not just those. We can look at the oil price too. Obviously, oil being the most industrial of all has to have a correlation with the global business cycle. And yes, again, like other commodities, you get these supply squeezes or demand squeezes or troughs that occur. But generally speaking, they closely follow the business cycle. This next chart helped me a lot in predict the falling price of oil from back in a couple of years ago when I said at $120 a barrel, it was going to 30. All I was doing was extrapolating using the crude oil year-on-year chart and the ISM. And you can see the relationship still holds. It's been a bit screwy recently because of how you match the lows and highs. You can shift around these charts a little bit because they're not perfect and they're never supposed to be perfect. So if anybody comes back to you and says, they're not a perfect fit, look at those gaps. I don't care about a perfect fit. It's the nuance, it's the texture, it's the direction, it's the core trend. That's what we care about. It's the over time relationship with asset prices that we need to care about. And I think this is a very clear chart. So now you're an expert in commodity prices and you're an expert in equity prices, you're an expert in the business cycle, you can forecast economic trends. And we've done that in about 15 minutes. The next thing I'm going to turn you into is a credit expert. Now, again, along with equities, I'm not suggesting that this will help you bottom pick the particular credit or particular equities or particular movements in certain short-term time horizons commodities. What it's giving you is the context. So if I pull up the next chart, you can see how credit is perfectly correlated to the ISM too. This chart is the chart of BAA versus AAA credit spreads. What it's showing you is when the economy weakens, obviously credit deteriorates. So it's an obvious relationship that I hardly ever see a credit analyst use or credit strategist. It's ridiculous because it's so usable and so easy. So again, what we know with credit is credit follows the ISM. We know that the ISM is going lower potentially. We therefore know that credit is likely to blow out. Not that complicated. Again, the complexity is in the outcomes where probability is in your favor, but it doesn't play out that way, which would be the 90s was a classic example of that. And again, I keep referring to that because, I never want you to believe that this will make you foolproof, but over time, it will give you a better probability of being right. Also, bond yields correlate obviously very well to this, and interest rates do. Well, they used to. This is where you see quantitative easing screwing up things because suddenly the bond market disconnected from the business cycle because there was no inflation that came. So that was a broken part of the business cycle over the long term. And also because the central banks became the world's largest buyer of bonds. So it distorted the business cycle and kept bond yields low. That's one of the reasons I've been particularly interested in being long bonds, because I think yields are going to fall because of the central bank buyer, the secular backdrop, and the fact that they do follow the business cycle too. The relationship is a bit screwy with the business cycle, as you can see from the next chart. But the point being that over time, the business cycle does move bond prices because it also moves inflation. So this chart is the chart of the CPI against the ISM. The CPI against the ISM is the same relationship. We can forecast inflation by using the business cycle. So this is why I have argued for so long with all of the consensus forecasts at the beginning of each year, because they've all not forecasted the business cycle is weakening over the last 3 or 4 years, and therefore inflation will fall over time. It's simple. And if we have the secular backdrop that we've got, we know that disinflation is the key trend leading to deflation. So again, it balances the probabilities in understanding what's going on. You do get situations where some cycles are shorter, some are longer, some are bigger, some are less big. There's things that we don't know about the cycle and that we have to try and reassess the probabilities as we go. So how do we do that? Because my probability is that I think the ISM rolls over, but where am I getting that probability from? Okay, the back data, the length of the cycle. It looks like we're due a recession in terms of the average length of a cycle. This is about the 4th longest cycle in history. How it's been morphing in terms of its trend, we understand that. But what I then do is I look at something else in this whole framework, which I think nobody else does in the same way, which is look at the short-term economic cycles. For that, I use the City Economic Surprises Index, or CESI, as it's called on Bloomberg. And that's given me a tremendous advantage. It's something I stumbled across maybe 4 years ago. And that's given me a tremendous advantage to understand where we are in the business cycle itself, and if we're going to see some uptick in data or downtick in data that's going to cause the ISM to rise or fall on its way down. Because nothing goes down a straight line. It tends to ebb and flow on its way down. So this chart is the chart of the CESI. And what it is the short-term economic cycle. It's basically how much the economic data is coming above or below consensus forecast. So if people are overestimating the economy, then i.e. data is coming out weaker, the CESI falls. If they underestimate, CESI rises. And it's incredibly cyclical, as you can see here. There must be within the economy a seasonal cycle that's not picked up in any of the data adjustments. But it does give us an advantage for that because it means that we can understand when the economic cycle is weaker. We know, looking back and back testing, that when the City Economic Surprises Index is going negative, then the likelihood is for the ISM to be falling if it's in the part of the down cycle. If you remember, we have an up cycle and a down cycle in the ISM. And the CESI reacts differently, or the ISM reacts differently depending on what the CESI is doing and where we are in that particular cycle. So in up cycles, in the negative part of the CESI cycle, we tend not to see the ISM being affected much. It may crawl higher, it may stabilize for that particular month or two while the CESI is going down. And then when the CESI goes up again, it continues higher. On the down cycle, the propensity is for falls. So when the CESI is on its way up in the ISM down cycle, you tend to see small rises in the ISM or sideways trends. When both are pointing lower, then you see much larger moves in the ISM. We're currently trying to find a top in the CESI now. We had the lowest ever top in history in the last CESI upcycle. It looks like we've topped out again below zero and we're rolling over. That means we should expect economic data to come out weaker than expected, and that will drive the ISM lower too. So what we are expecting is this little uptick we've had in the ISM in the last couple of months should peter out, and we have the balance of probabilities in the favor of it falling. Obviously, we assess as we go. If something changes, if this CESI down cycle doesn't bring the ISM down, then we have to mark that as interesting, maybe something shifted. But all I'm trying to explain is how to best put things in your favor and for you to understand what's going on at any one phase within a matter of minutes. That CESI chart has allowed me to do interesting things. I've been able to forecast because I know where the ISM is. So back last year, I said that Q4 to Q1 was going to be very close to recession in the US because the CESI was down and the ISM was down. Well, guess what? It came out pretty close to zero. Now we've had the uptick and now it's rolling over again, as I suggest. So I can go out and make a forecast and say, I think the US has a high probability chance of being in a full recession by Q3 2016. So there you go. You're basically an expert in the business cycle. You can forecast asset prices around the world. You can have a good understanding of what bets you should be taking, what bets are riskier. I think all you need to understand is you start with the top down, the big picture. Where are the secular cycles? You then go down to the business cycle. Where are we in the business cycle? What can we expect going forwards? Then you look at the short-term cycle and understand that. You put all of those together and you have a really good understanding. So if I were to look at those, as you can tell, my probabilities have to be biased towards being bearish equities. But equities won't really go down until the ISM crosses 50. It crossed briefly. We had a sell-off in the equity market. It needs to cross 50 again for us to get bearish in equities, which is why I'm not particularly bearish in equities now. I have a bearish bias, but I don't have many positions. However, I do have bond positions because bonds tend to just follow the cycle anyway. And with the secular backdrop, I know that they're going to fall in yields over time. And bonds tend to look forward towards recessions much earlier than equities do. So I think overall, you too can make any forecast you'd like. Maybe you think I'm wrong and you say, yeah, I understand the probabilities, Raoul, but I think that we're going to get the 90s again. Well, if that's the case, you can set a group of parameters around where you're wrong, where you're right, what the ISM should be doing or the CESI should be doing, and you could trade accordingly. You could say, I'm going to fade your view, Raoul, because I think we're going to muddle through. Muddle through should mean that equities tack on 5%, 10% a year gains for the next couple of years. It's distinctly possible. I'm very nervous seeing the equity market near its all-time highs again. But again, we can't tell anything until we get the next big move out of the cycle. Once we do, we'll know everything. And I think really why I wanted to do this is I've for a long time been promising to write a book about this and never having the time. I just get very frustrated in what happens in the world of economics and the world of economic forecasting. Everyone's increasingly frustrated with the Federal Reserve, who can never forecast anything correctly, to most of the Wall Street economists who don't. They get periodic snapshots of being right, but nobody will dare give themselves a probabilistic framework of how right they will be over time. But I can pretty much do that with how I do this. I think to try and pretend everything is a science is lunacy. What you should understand is this is a behavioral science, which makes it an art. We're understanding human emotion, human behavior. And these things are what drive economies. These things are what drive asset prices. And once the world gets a bit smarter and universities teach people more about the real world of economics and what really drives financial assets, then we can have a better investment world. And I think that's one of the reasons I started Real Vision, was to get people to understand there is a broader world than the narrative you are generally given by the media or by your university or by your workplace or by the firms you work with. And I think it's really important to broaden your horizons and understand that the world is not how people tell you it is. It's a much more complex and nuanced world, but it is forecastable, it is predictable within relative ranges. And nothing is perfect, but all we're looking for is something that's more perfect than anything else. I hope you found this useful. and love to hear any feedback. Thanks very much.